Hi, this is Steve Hutchinson with Hutchinson Family Offices. And in this video, I wanted to update you on basically the reason for the recent volatilities and our perspective on the markets and the economy. Now, first off, I want to remind you, don't forget about our 2018 Outlook Conference. It's going to be held at Grandover Center Thursday, March 15th. And the conference will begin at 6:30 p.m. Now, we have a number of key speakers that are going to be there with us. We have Bob Bourne with Bourne Financial Group. He's going to be discussing industry trends in senior housing. And we also have Barry Goff with Triloma Capital Group, and he's going to be sharing with us their insights on energy financing and as well as tax structures that we see impacting this year with the new tax law. So it's going to be a great program. We hope that all of you can come. If you haven't made your reservations yet, please get in touch with Melissa at area code 336-235-6601, or you can email her at melissa@hutchinsonfamilyoffice.com. We look forward to seeing you there. Now, in this video, I want to share with you a few commentaries and our take on where we are right now. Now, for the most part, what we're seeing is, on the tax side, some very positive influences. We're starting to hear from companies about substantial amount of taxes or tax reductions that they're expecting this year. And as a capitalist, I believe that businesses and individuals are much better at allocating their capital than the government would be. And that's basically what we're dealing with, is companies having more capital in their businesses to allocate. And I think that's going to be a very positive influence on the economy. Interest rates of inflation, we really don't have any concerns here. I think most of it's being overblown by the media. It is somewhat disturbing to watch how the media gets on a wheel and starts talking about these types of things that really, in the broader perspective, are normal. Inflation today is still relatively low at 2.1%. The Fed's target is around 2%. That's nothing to jump up and down about. We're also seeing interest rates. The 10-year rate is under 3%. And if it goes up to as high as 3.5%, we still don't have concerns. We don't believe the interest rate or inflation market at this particular time is something that will put a stop to this bull market. The third thing is the economy is on solid footing. Employment is growing. We're starting to see wage growth, and the government is taking less of the incomes that are out there. So these are all positive influences in the economy. We should see fairly good GDP in the first quarter. I'm anticipating somewhere in the 2.5% range, and then I would say in the second quarter we'll see even stronger GDP. Usually in the first quarter of any in our economies, we've seen very low GDP in the first quarter. I think this will be a pleasant surprise, and I think we'll see some positive moves there. Now, our take on the volatility. Basically what I want to try to do is explain this correction in layman terms, but basically we experienced 11.3% correction, which is really normal. That's very common to have that. It was not driven by fundamentals. Nothing changed on the fundamental side of this correction. It was not driven by interest rates or someone's batteries running out of their kabuki doll. The bottom line is that what it was driven by was an unwinding of risk. And as long as investors continue to put capital, institutional investors continue to put capital into market derivatives, we're going to have this type of volatility. We'll look toward the regulatory agencies to possibly tighten this market up a little bit, but we fully expect volatility to continue. The markets have recovered about 60 to 70% of the drawdown so far. That's being expected. And I think what's most important now is maintaining the proper perspective. It's important to remember stocks can go from green to red without triggering a yellow light. And it's very important to understand that. Remember 09 and 08. So we believe the markets will continue to experience some volatility as they learn more about Fed policy and direction. And of course, these persistent use of derivatives will have an impact on the market as speculators. Remember, it's our nature as human beings to both speculate and try to predict the future. That's just what we do. And unfortunately, that doesn't do so well in the financial markets. One of the things I have in front of me here today is a copy of the annual report of Berkshire Hathaway. And I have read this report every year for the past 30 years. It's one of my annual reads. I sit down, as you can see, I mark it up. I make points that I like about it. And it's a very, very strong narrative on what a successful investor like Warren Buffett can do and how he speaks at this in plain English. What I get from it is mostly tremendous insight. Now, if you'd like a copy of this, give Melissa a call. She can email you one, or you can find it by typing Berkshire Annual Report on Google, and you can download one yourself. I would recommend it. But like Warren Buffett, we see the companies we invest in as interest in businesses, not ticker symbols to be bought or sold, or their chart patterns or target prices. I mean, we're really pretty much very conservative in our investment management policies. We ignore the opinions of the media pundits and so-called analysts that so freely give us their unsolicited opinions. I've often said, if they're so convinced they're correct, then why are they telling us? You know, did a benevolence bug bite them? I don't believe so. So we take that information with a grain of salt and focus on the fundamentals. So let's talk a little bit about 4 of our core holdings and why we have those. Let's talk about Amazon. Amazon speaks for itself. It's a great retailer and generates significant free cash and is certainly one of the leading in their industry. But the one thing I want to take away from here is don't overlook their services. They're building a tremendous cloud-based service, and they're competing aggressively to other providers in this area. And this is a very, very strong area. Yes, they can get your Tide Pods to you in 2 days, so don't let the millennials worry too much about that. But the bottom of that is just the tip of the iceberg for this company. Their service model is growing tremendously, and that's why they trade at the multiple they do. Let's talk about Apple. Apple's not just devices, iPads, iPhones, HomePods, whatever you want to call them. Again, this is a tremendous service model. They are building tremendous amount of services, cloud-based services, music services, movie services, all filtered through their devices. Tremendous business. Don't overlook this. Don't think that Apple is just a really cool phone. It is much, much more than that. Let's talk about Berkshire. Berkshire Hathaway is one of our top holdings. It's one of the most successful companies in history. Last 15 years, they provided their investors on market value, now not on book value is much higher, but let's just talk about market value. On market value, 167% cumulative market value increase compared to the S&P with dividends at about 148. In the last 5 years, their market value has increased from 109% versus 81% on the S&P. That speaks for itself. I don't have any questions about the success of this company. I love their long-term perspective. Finally, Sherwin-Williams. This is probably the best story in consumer and industrial products that you can find out there. First, we don't have to worry about the Chinese sending a tanker full of water across the ocean to compete with them. They are just they're almost competition-proof in many areas. They generate tremendous amounts of free cash, and they pay a very nice dividend out to their shareholders, and they're conservatively managed. Again, Sherwin-Williams is one of the leading best stories in consumer and industrial products. They do a lot more than pass out them little paint squares you get at Lowe's. So what I've learned over time is that the markets are very rational, although they can do some crazy things. I'm reminded seizing opportunities that are offered generally do not require a great degree of intelligence or a degree in economics or familiarity with Wall Street jargon like alpha, beta, whatever. What investors need is the ability to disregard the mob fears or enthusiasms. Unfortunately, many folks don't. We focus on the fundamentals and develop a willingness to look unimaginative for a sustained period, or maybe even look foolish at times. We believe it's essential to the long-term success in your portfolio. Now we'll remind you about the conference again, Thursday, March 15th at the Grandover Center. It's going to be one of our best and only program of the year for our Outlook program. Make sure you give Melissa a call, drop her an email, and we'd love to see you there. Thank you again and have a great week.